All right, looks like we are at time, so let's go ahead and get started. My name is Chinda Chun, and I'm with NACB and the Consultants Training Institute. Before we get started with today's Around the Valuation World International webcast, I want to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that will pop up on your screen during today's webcast. If you have an AVW International subscription, your CPE certificates will be available on the NACB.com portal within 7 to 10 business days. If you do not have a subscription yet and you are interested in getting CPE for these monthly webcasts, there is a link in your materials that you can click on, which will guide you to the page to view that, or you can contact our member client services team. If you have any questions during today's webcast, please use the Q&A feature in Zoom, as well as be directed to the presenter. If you have any technical questions or questions about NACBA, please use the chat feature, as well as be directed to me. With AVW, Around the Valuation World, and Around the Valuation World International webcasts, we try to cover some hot topics in the industry. We have a number of resources that we pull from, along with some other special guests. If you would like to, we can't obviously discuss every article that has been published, but if you are interested in looking at some additional articles, there are some references in your material that you can access to obtain that information. And this is our panel of editors. We have Wolfgang Nies, Andrew Newman, Pratik Shah, and also Brian Jones. Today, we actually have Pratik Shah joining us, who will be working with us and a presenter during the webcast today. I'll start off with a little bit of business valuation news, and then I'll turn the time over to Pratik, who will introduce our guest, James Walling, discussing fair value, accounting's perspective on valuation. And then the GAC news, I just want to play a quick video. We do have our conference coming up, and I just want to give you a little bit of information on that. Cool. All right. And with that, I'm going to turn the time over to Pratik, who will introduce our presenter, James Walling, and we'll get us started for today.
Hey, thank you, Chanda, and good morning, everyone. Happy to introduce my mentor, Jim. Jim is the founding principal of Accretive Strategies Consulting Group. He has worked in the consulting, corporate finance, and valuation area for over 30 years and is the founding executive director of the Academy of Certified Valuators and Analysts, which is the India chapter of GACVA. Jim holds an MBA from Santa Clara University and a BS in Marine Sciences from Stockton University. He has spoken, written, and taught on corporate valuations, real options, derivative, security structures, and valuation and security design. Today, he would be presenting an interesting topic, which is probably very important for a lot of people, which is on fair value accounting's perspective on valuation. So with that, I would not like to waste much of everyone's time. Jim, over to you to take over the conversation. And again, thank you on behalf of NACVA, GACVA, to take this topic for Around the Valuation World.
All right. Thank you very much, Pratik. Let me go ahead and share my screen so everyone can see the presentation here. There we go. All right, so as Pratik mentioned, we're going to be talking about fair value. Fair value is the accounting standard here in the US that we use for evaluation purposes. Second here. And why isn't this? There we go. Okay, so we've done the intro on me. We don't need to talk about that again. So I titled this Accounting's Perspective on Valuation because that's really what it is. It is a new framework that the accountants within US GAAP basically have put together That is the basis. And when I say new, as we'll talk about, it actually isn't new at all, but the framework itself and what goes along with it was really sort of first codified not that long ago. One of the most important things that we need to remember, though, is fair value is a term that's used in a lot of different ways. And so we need to make sure that we understand what we're talking about. I mean, it can show up in litigation, it can show up in marital dissolution, it can show up in state court type of thing. So those are all different definitions of fair value. The one that we'll be working with is governed by ASC 820. That's the standard that lays this out. And basically it's, like I said, it's a framework of how this is going, how these valuations have to be done, the things that you need to look at, the perspectives, etc. Unlike fair market value, which we all know and love, there is not a lot of litigation type of support for this. Fair value, as I said, it's a relatively new standard, and therefore it doesn't have that kind of background behind it. And so what really governs how you do the work is best practices through things like accounting interpretations, guides that are written by different groups, and just historical practice itself. So it's a very different, you don't have the case law to fall back on. When we talk about ASC 820, that's actually the Accounting Standards Codification topic 820. So if you were to go look this up and try and find out, okay, what is this thing? That's what you would search under. I would encourage you to actually do that. Read it if you're going to do fair value work. Understanding the framework is extremely important. But its basic purpose is really to, one, clarify, and two, standardize the process of valuing assets and liabilities. And that's kind of a little different. When we talk about fair market value, most of the time we're talking about assets. This standard covers both assets and liabilities, and so it's important to do that. And really what they're trying to do, and I'll talk about this in just a bit, is they're trying to ensure that investments are reported at what they call fair value, which is something approximating what they would sell for in the markets today. As I mentioned, this is not a new concept at all. In fact, if you look at it, the codification actually began back in around 2006, but fair value accounting has been around for a long time. In fact, it was used pretty extensively in the early 20th century and ultimately led up to the stock market crash in 1929. Obviously, when that happened, the regulators were looking for some place to lay the blame, and fair value took a chunk of it. And in fact, what ended up happening was the SEC actually banned it in almost all cases from 1930 until sort of the late 70s, early 80s. There were only a few very restricted places where you could use fair value for your financial statements. Most everything had to be done under a historical cost concept. That had some real implications, and I'm going to sort of go off path just a little bit here and talk about what went on. So you think about that. You say, okay, we've had, basically leading up to sort of 1980, 50 years of historical cost type of accounting. What does that mean? Well, that means that, things go on the books at their original cost. They get depreciated over time. They are never written up unless there's an actual transaction, but they can be written down. So as you can imagine, what you end up with is some very conservative balance sheets. And in fact, that led to what we can term merger mania that occurred in the 1980s, because the balance sheets had become too conservative at that point. And so then, if you think of it as sort of a pendulum, this regulatory pendulum of what you're using from an accounting standpoint, it swung the other way, and it swung towards, after sort of that period, it swung towards fair value. Fast forward 25, 30 years, we've got the financial collapse in 2008. Fair value was a big piece of that because of the weaknesses and the judgment that goes into it, as we'll talk about a little bit more. And so risk is a key element of this framework now, in terms of how it's being put together and how we are measuring fair value. So let's talk about definitionally. So what is the definition of fair value from an accounting standpoint? Well, it's the amount at which an asset or a liability can be bought or incurred, in the case of liability, or sold or transferred. Importantly, not settled. So this isn't a settlement, it's a transfer. In a current transaction between willing parties that is other than a forced or liquidation sale. So you can see there are some parallels there to fair market value, but there are also some significant differences. And those significant differences have a lot of implications for the way that you are doing your fair value estimates when you're doing things for financial reporting purposes. As I mentioned, risk is a key element of what the framework is trying to capture. It's trying to recognize that. And accountants, they love this stuff. They love frameworks, they love hierarchies, anything like that. So that's really what they've done, is they've looked at this and they've said, okay, what are the important factors that we care about? And one of the big ones was, okay, how liquid are these securities or these assets or these liabilities? How easily can I transfer them? I've built my framework around the ability to transfer. So now the question is, okay, how easily can I transfer them and get those done? So we say, all right, we've got that. Ultimately, what they came up with were 3 levels of a hierarchy for these things. And those levels, excuse me, basically, their asset liabilities. What those levels do is they drive disclosures. So not only do they have implications for how you do your work as a valuation professional, but then they have implications for the disclosures that the company has to do around those values. Hence, if you think about it, okay, if the company has to have disclosures, that means there's an auditor back there somewhere who's auditing all those disclosures. Well, what supports those disclosures? That's our work, right? So that means the auditors are going to be looking for something from us in the way of documentation that ultimately supports not just the numbers, but the disclosures that the company is going to be providing, to their investors, to the users of financial statements. So as you're thinking about fair value, one of the things that you need to be really thinking about is, okay, what are the implications for this from a level? What level is this asset or liability going to be at? What does that mean for me in terms of the documentation that I'm going to have to do, the support from my work? Because the one thing about fair value is that there's an auditor out there somewhere who will be looking at it. In almost all cases, fair value estimates will be subject to an audit type of review. And so that means the valuation professional in the audit firm is going to be coming in and they're going to be looking, but also the auditor themselves is going to be coming in and looking and seeing, okay, because the auditor owns pieces of it. Under the fair value framework, the auditor sort of owns the forecast. So they're the ones that are going to be reviewing management's forecast or anything that you do to extrapolate that forecast or adjust that forecast in any way. They're going to want to take a look at that and understand what's going on, and you're going to need the support behind the reasoning for what you did in terms of that kind of adjustment. So that's something that you also have to keep in mind as you're working through a fair value analysis, is you're knowing that, okay, this is going to be reviewed. So let's talk about the levels. Level 1, these are easy. These are highly liquid assets in active markets. This is a public stock, is a great example. We term this often mark to market. So we've got a price. We can go out there, we can look, we can say, yeah, okay, here's the price. I'm good. I know there's lots of volume in that. And now, then you start to get into the nuances. Okay, wait a minute. I've got a public stock, but maybe it's not trading every day. Well, now, am I in an active market? That suddenly becomes a question. It's like, okay, I need to think about that. I need to look at them, maybe do some analytics around, okay, how much trading is going on? What's the bid-ask spread look like? How wide is that? That may be important for what I'm trying to know. How frequently is it trading? What kind of volume is it trading? It could trade every day, but if it's trading in minuscule amounts of volume, that's something that you would need to take into consideration. And something just to keep kind of in the backs of your minds if you're ever looking at this kind of analysis is it's a known fact that organized crime plays in this space, in these thinly traded stocks, and they will use pump and dump schemes and things like that to try and make money on some of these things. So you need to be really look at this stuff and say, all right, am I comfortable that I do meet the highly liquid in the active market types of standards in terms of a mark to market type of thing. All right, I think we've got our first polling question. So give folks a minute to respond to that.
Hello, Jim. You can proceed with the presentation during the polls. Yeah, there's no need to pause. Thank you.
Okay. Just a second. There we go. Okay, so level 2. Level 2 is often referred to as mark to model. So these are assets that likely have to be modeled in some way to get to an answer. So there's no active market for it. You can't just go out there and pull a price in terms of doing that. So they are less liquid than a level 1 asset, but as we'll talk about, they're more liquid than a level 3. There is some type of pricing information available out there in the market, but it may not meet both the tests. It may not be an active market, or it may not be a clearly defined price in terms of doing that. And think about the way that bond markets used to run. I mean, you have to go to dealers and to get an estimate, get quotes on what those would be. That's not necessarily sort of an active freely tradable market that you can work in. Even though there may be a lot of transactions, you can't just go to a price and find it. So you need to look at that. So this is often referred to as mark to model. You're taking some inputs that are observable. So maybe you've got some bonds that are very similar to yours that are trading out in the market, similar terms, similar industry, all those things. And you can look at their pricing and how they're pricing. You can use those to analogize and try and get to what yours. So there is some market data out there. It may not, but it's not your exact security. It may be a portion of that security in terms of doing that. And then ultimately you're able to use that along with the model and the inputs associated with it to get to an estimate of price. That's a level 2 type of asset. Level 3 assets are where we live, honestly. This is the place where most of the things that we are going to be valuing are going to be in, if you're talking about, company equity or things like that. A lot of derivatives are in this space, a lot of liabilities, and it really, the issue is that there is not observable inputs out there. So you can't look to a price, even of an analogous security. There are things that you're going to have to work out. You're going to have to estimate a volatility, maybe, to go into a model, or you're going to have to make a determination on what's the appropriate cost of capital. You're going to have to make a determination on, gee, what's the appropriate term for the model that I'm going to be working with, to try and come up with this. So you have to develop these inputs that are not readily observable in the market. Complex derivatives are a natural, since they are obviously, valuing privately traded securities or private securities. Those are the place where we tend to do most of our work around this, but all of these things ultimately will end up as level 3 in your hierarchy of fair value. And along with that, obviously, comes the requisite disclosures and support and all the things that you have to do, because what really happens is when you are doing your fair value estimates and you're looking at, okay, what kind of documentation do I need to provide along with this? As you move down the levels, the documentation load increases, and so you need to make sure that you're there with that. One of the first questions that I ask whenever I'm scoping a project is, who is your auditor? Because that is an issue that you're going to need to understand. And if you're working with one of the global 6 accounting firms, then that's one process. If you're working with a small local or maybe a regional audit firm, that process may be different. Their knowledge base may be different. How are you gonna? So you need to understand who you're dealing with there in terms of it's going to impact the way you look at your estimate and the work that you have to do. So there are some key parameters around fair value that you need to understand, some terms that need to be defined, and you need to understand sort of how they're viewed. One of them is that fair value presumes an orderly market between what are called market participants, and I'll talk more about what those are and who those are. But that is actually a key element, because who the market participants are, and in fact what the market is, can change in a fair value context depending on the facts and circumstances. And it's not always the market that you might think for the asset or liability. So you need to be thinking about that. So when you think about that, we've got these market participants, they're operating in an orderly market, but what do we actually have to value? And that goes to our scoping, but it also is influenced by an accounting concept called unit of account. And that's the level at which assets or liabilities are aggregated or disaggregated. So if you think about it, if I'm valuing a company, there's a lot of assets that are aggregated together to be in that company. Whereas if I'm valuing a building, that's a different story. There's, that may be a single asset that I'm looking at. But, you can have anywhere along that spectrum too. You can have a situation where you need to aggregate certain other assets together to get to, what is the thing that I need to value? So you need to be cognizant of this issue of unit of account and how that plays in with fair value in terms of where it works there. So when you're measuring your asset or liability, fair value, you need to think about, is this a standalone asset? Is this, maybe a company? Is it a reporting unit within an overall business that has multiple reporting units? If you're doing any kind of impairment analysis, which is one of the primary fair value types of work that gets done on a regular basis for companies, impairment analysis looks at the overall company, but it has to look at it on a reporting unit by reporting unit basis. And that's driven really from how the business operates. Do they have standalone divisions that maybe need to be done there? Or do they run everything as one big company in terms of that? So obviously size of the business is going to impact that. Geography, do they have multiple geographies that they're operating in? Do they have multiple business lines? All of those things impact, what's the appropriate unit of account in terms of doing that. And so this is another one where you're going to rely on the accountants. The accountants are going to tell you what the right unit of account is. That's not a determination you have to make, but you need to make sure that you're asking those questions up front and making sure that you're getting the information you need so that you use the appropriate unit of account for the work that you're doing, and you don't just go in and say, oh yeah, I'll just value the business, and then discover that, oh, there's 3 business lines and I really needed to know the value of each individual one, for the purposes of what my client needed. So you pay attention to that one. This is a big one. This is a market-based measurement. It's not entity specific. That's important because it impacts who the market participants are, and it also impacts the things that you do and do not consider. So you always need to keep this, top of mind when you're working on a fair value estimate, is that I care about what market participants think about this. I don't care about necessarily specifically what my management plans to do with it in terms of an asset or a liability. So then you have to back up and say, okay, well, who are these, market participants? Who are these, who are these guys? So market participants are your buyers and sellers. They are operating in this orderly market, as we'll talk about it. It's one of two potential definitions of the market. And we'll get to that in just a second. But these are independent players. They are reasonably knowledgeable. I mean, reasonable is not in the definition. I'm using that, but they're knowledgeable about the asset or liability. If you think about fair market value, reasonable knowledge of relevant facts. Well, these people have, some knowledge about the asset or liability. So they're not coming in cold in terms of doing that. They are operating in one of two markets. They're either operating in the principal market, or they're operating in the most advantageous market. And you have to make that determination. And basically it's sort of a default scenario is if you can't identify a principal market, then you have to identify the most advantageous market that they offer. So if you think about it, that has a lot of implications for value, doesn't it? I mean, that can, put you in a different market than maybe where you're operating. I mean, think about a company that is, company's operating and it also holds a bunch of land. And if the company is doing well and those cash flows are dominant, then your principal market would be, okay, the market for people who want to buy that kind of company. But if the company falls on hard times and the cash flows drop down and suddenly you look at the land that they own or the real estate, and that land is suddenly worth more than the company overall, well, that shifts your market, because now you need to be looking at real estate investors, or developers or whoever it might be who would be interested in that land. So there are implications, in terms of, okay, what market should I be in, actually based on the makeup of assets and where the cash flows are coming from, what's dominating that area in terms of it. So they're operating in that place, but here's where it comes back to where I mentioned before about this is a market participant view of things. So let's say that you're valuing a company and you decide that, okay, the principal market is people who want to buy this company. So now I start to develop. So management hands me a set of projections and you ask them, say, well, what do these projections have in them? I said, well, this is our baseline business, but then also here are the synergies that we think that, a buyer is going to get. Okay, so now you've got some things in your forecast that you need to pay attention to. And suddenly you start to look at the numbers and the company comes back and says, oh, gee, we need to revise our forecasts. Why? Well, we've got this interested buyer and they have these other synergies that we think that they can get. So we want to make sure that we're negotiating for those. Well, if you're helping them with the sale, you absolutely want to do that. If you're doing a fair value estimate, you absolutely do not want to do that. You cannot take into account buyer specific synergies. You can take into account market participant synergies. So if you think about it, if I'm, buying a company or merging two companies, I don't need two CFOs. I probably don't need two accounts payable departments. There are things there that that, okay, any market participant buying this company is going to get these synergies. Those you take into account. But if, oh, gee, our product fits really well with this particular buyer and it's going to open a new market, but just for him, that you don't take into account. So your fair value estimate, you can see how it diverges from maybe even what you might think about as from a fair market value perspective, or an investment value perspective. And so you need to understanding the framework, how it works, what you can and can't consider becomes very important coming up with that estimate.
Thanks, Jim.
Did
you see a question that came up?
Yeah, I was just noticed the question popped up. So let's see. Fair value standard blockage. I will get to this. So yeah, good question. I will talk about blockage in a little bit. All right, so we've talked about principal market, we've talked about most advantageous market to some extent, but a few parameters that you need to be aware of. One is principal market is often defined by greatest volume or level of activity. So where are things? So if you have, 2 or 3 potential markets that this, business or asset could be sold into, the principal market is going to be the one where there's the most activity and volume going on, unless they're close enough that you can't really just say one or the other, in which case now you go, okay, well then which is most advantageous? When do we think we're going to be able to get the best bang for the buck in doing the sale? And so now, and that's what will drive you into that market in terms of doing that. Management intended use of the asset or liability doesn't matter. So for those of you who've been doing this a long time, you can remember a point where basically what management intended to do was actually incorporated into value. So it was sort of an entity specific type of view. And so the management would tell you with a trademark, oh, gee, we have no intentions of using that trademark ever at any time. We're just going to put it on the shelf and leave it there. So you'd say, okay, done, zero value, move on. Well, not in fair value. In a fair value context, you have to look at that and say, okay, what would a market participant do with this trademark? Well, a market participant might actually ascribe some value to that. They might have the ability to use that, in which case, okay, now I need to go through the exercise of estimating that value, from the market participant's perspective, potentially in the most advantageous possible use of it, as long as I have access to that market and I potentially could do that. And so now you build that piece in terms of doing that. Excuse me for a second here. All right. Oh, is that another question or is that the same one?
I believe that is the same one. I'm gonna hit
Okay.
answer live.
Answer live. Yeah. Okay. Get that. All right. Just a second here. It's like whenever I take some kind of action, it takes it a minute. There we go. Okay. So there are a few things that you need to consider when you're thinking about a market, particularly for non-financial assets. And that is, can you really use that? I mean, you've got this issue. This feels a lot like sort of highest and best use, doesn't it? When you think about that most advantageous market. So, okay, what's the best way that I can do that? But you actually have to be able to transact, because we have to go back to the definition of fair value under ASC, and it really is it's a transaction. It's an exit price type of concept. And so, one, you physically have to be able to execute a transaction. So there has to be a way to actually do it. If there's something that would block you from ever, physically being possible to transact, then you obviously couldn't do that. Secondly, it has to be legally permissible. So there can't be something in the way. And think about okay, you're going to sell a business that owns a building. Great. So selling that business is, easy. Yeah, we can do it physically. It's legal. We can come up with a deal. Great. We can sell that. Now let's just tweak our fact set just a little bit. And it turns out that building, that's a historic building. Okay. Still physically possible, may not be legally possible. Or under it really is, it may change both your market, what's your principal market, and it may also change who the market participants are. And so that's kind of out there. So if you think about that, if you were about to determine that, oh gee, I think that the person who, or the likely buyers here are developers. They're going to want they don't care about the business. They're going to tear it down and they're going to build condos. Well, that's great until suddenly the building has, is on a historic registry and now they can't tear it down. That whole buyer set goes away. So you've got to think about that kind of stuff and how it's going to work. Or, financially feasible. So there's got to be a way to do it. If there's, some type of blockage, maybe it's a international transaction and there's some laws that are getting in the way. We've obviously seen a lot of that going on. Think about what's going on with Russia and Ukraine, and with all the sanctions in place, and all the things that companies that are having to try to divest, or are having have had their businesses taken away from them. And there are things that really make that difficult to do. And it just may not be financially feasible, from the simple reason that you can't move currency in and out of Russia right now. You just can't do it. So, okay, how do you manage something like that? So that would make that market not available for you. But what you're looking for is to provide that maximum value. They're trying to get to, okay, what is that value in a transaction that you potentially could get? And do you need to have this? Can you sell this asset standalone? Does it need to be bundled with some other stuff to make it so? If you think about a business, the accounting definitions now around what is a business really talk a lot about sort of groups of assets, and what are the groups of assets that ultimately make the business viable, that make it so that it will in fact operate and can do that portion of what they're doing. So let's talk. Polling question number 2. All right. All right, so that one's passed. We'll give folks just a minute there. Okay, hang on one second. I've got something in the chat. Okay. Nothing there. And I see a couple of questions. So while we're working through the polling stuff, let's get those. Okay, we talked about that one already. Let's see. Now, Manna has plans to close a brand, particularly in relation to smaller businesses. How can we as valuers support what other market participants might do? Isn't this very subjective judgment call? And if so, how can we limit the subjectivity? Okay, great question. You're absolutely right. It is subjective. When the fair value standard came into place, there was and there continues to be a lot of discussion around these issues of what is the principal market or most advantageous market, who are the market participants, and how do you define those things, and what are the criteria that you use. And so, yeah, as an analyst, you've got to work your way through that and ultimately get to the support of how, okay, this is what I think the principal market, and here are the reasons why. These are the markets, and sometimes you have to do some negative assurance too. So these are the other markets we considered. These are the reasons why we don't think those are the right markets. And then you take it to the next step. Say, okay, who are the market participants in those markets? Who are those likely buyers? And from that, then you have to somehow infer, based on different types of analysis. Maybe you're going in and looking at sort of royalty rates and things like that, or finding it and trying to find other ways that, okay, how does a market participant put value on something like this brand? And so you can look at that and say, and one of the places, particularly when I'm looking at brands, I like to go to actually to purchase price allocations. So that data is available through databases like Markables, where you can go and you can look at purchase price allocations, and you can see, okay, what percentage of the value of the overall firm is put on the brand. And so if you look at enough of that data and you work through some of that and say, okay, yeah, I can get a general sense of, in this type of business, in this type of industry, of the firm value, here's a rough idea of brand value. And then you have to make, determine based on your individual brand and all those parameters, okay, where do I think I fit within, a spectrum of values, and why that it's that particular one. But it is subjective. But that's kind of what we get paid for, right? We bring not just the science, but the art. If it was just science, then AI would have our jobs by now, probably, or software would. We've all seen it. There's a lot of software programs out there that claim to do valuation, and some of them do a real good job, 70, 80, maybe even 85% of the time. But this is a zero defects business. You can't be wrong 10 to 15% of the time. All right. So let's talk about some constraints around this, because there are a few. We had a question earlier. Why blockage? Why not? Why can't you use that? Discounts. Think about the fair market value definition again. It's talking about an active market. And it's talking about a market participant's view. Well, how you choose to sell a block of shares, and remember, we're talking at the higher level on assets and liabilities, but we'll use shares since those are the easy example. If I, as a holder of, maybe I hold 30% of the shares in a company, it's my decision whether I choose to sell it all at once or to dribble it out over 6 months' time. That's like a company specific synergy kind of, isn't it? It's okay, if I'm willing to take that hit, I can sell it as a block, or I can, spend some time and strategically trying to bring it out to the market and have less impact. Doesn't mean that a market participant would necessarily do that. And so that's why they basically don't, they don't allow for blockage. Is it's an individual asset holder's choice as to what they do. It's not necessarily indicative of a market participant, in an active market. So that's the blockage piece of things. On the another restriction that you've got here is you cannot take into account restrictions on securities if that restriction is separate from the actual security itself. So the example I would give is, let's say that I do a fair amount of work in the venture debt space. Venture debt deals are, basically a loan and warrants. So those warrants invariably have a provision in them that say that, if the company goes public, we will have a market standoff for 180 days. That's embedded in the security contract itself, which means that type of restriction you should take into account fair value. Now let's take an alternative fact set, and that's that we've got a warrant, and maybe it's a warrant that there's a little bit of trading, whatever, but it's, sort of out there. There's no restriction at all in the warrant, but then you have a separate investor agreement. And that investor agreement says that you as an investor agree that you're going to have 180-day standoff, associated with that warrant that you got for whatever reason. In that case, you can't take that into account of fair value. And the reason is because that restriction is separate from the warrant itself. So if you were going to transact in the warrant, that restriction wouldn't go with it. So that's sort of what's going on with that one in terms of that. So you have to think about these in terms of, some of these restrictions that exist out there. The other one is transaction costs. Transaction costs are viewed as not attributable to the asset or liability. Therefore, they should not be incorporated in fair value when you're doing your estimate of fair value. However, and this is kind of a unique one, is that where you do take transaction costs into account is when you're arriving at what's the principal or most advantageous market. Because when you're looking at that, what you want to be thinking about is the net realizable value. So, okay, so now I do have to take them into account when I select my market, but then I don't take them into account when I do my actual estimate of value. So, just another one that's, is in there. When you look at it from an economic standpoint, it's like, okay, does that really make economic sense? You could argue it, but the accountants have decided that because we're focusing on, a specific asset or liability, it should not be embedded in there necessarily. All right. Second here. All right, I think I'm actually moving pretty fast through this. So there are some downsides to fair value accounting. If you haven't already sort of figured that, you get a sense that, gee, there's some interesting stuff going on here. remember, this is accountants who've built a framework. Valuation may not have been at the top of their list when they set up that framework, but they did so. But they've created this framework, these estimates, they're going into the financial statements, and it's been built with the goal of helping the user understand how risky that estimate is. That's the ultimate goal here from the account standpoint, is help the financial statement user understand, how risky is this, and then provide enough sufficient disclosure that they can make an assessment of that, at least to some degree, on, do they believe that estimate? So first one, it really lacks a solid foundation as a starting point, unlike historical cost. That was the real plus to historical cost accounting, was that you knew, okay, somebody paid $1 million for a machine. That's a hard number. So now I have a place to start. And now I can decide, okay, 5 years have gone by. I can look at things. I can look at how they've depreciated it. I can look at, okay, what's maintenance records look like, if you really want to dig in, and you can try and understand. Then you can make your own estimate, but you've got a foundation to start from. Fair value estimates, you don't. It's some other analyst's estimate of value. So he's made a whole bunch of assumptions and brought in, inputs and things like that, and come up with this estimate. And so now you're sort of starting with this nebulous thing, saying, all right, do I agree with what's been done? Do I not agree with what's been done? Do I even know what's been done? Is there enough disclosure there for me to really tell what's been happening? There is significant judgment, obviously, that's going on, not just on the part of whoever's doing the valuation themselves, but also on the part of management, because management's making determinations typically around things that are inputs into that model. So you're trying to get an estimate in terms of that, but there's, you don't have a foundational number. There's a lot of judgments that's been built into that. And not only if you're coming up with the value of this asset or liability, this is going to feed through to your income statement as well. So the fair value implications, from the balance sheet to the income statement also change, the dynamics of, okay, what's the cash generating capability of this asset, and you forecast it. When an analyst has made an estimate of what that is, do you agree with their estimate? Well, you may or may not have enough information to be able to do that. The other thing is, how do you compare it across firms? Management makes determinations about how they interpret the accounting, and each management may interpret some of those things different. If you talk to accountants long enough, you start to realize that while GAAP is rules based, there's still a lot of flexibility there. And in fact, all of the large accounting firms have groups that are dedicated to just tearing those rules apart and figuring out the best possible interpretation for their clients. And then they work out from that. So to the extent that there is flexibility within the accounting, managements can make different choices in terms of that. And then you have the analysts also making different choices on assumptions. So again, you start to see how you've got this nebulous estimate that you, as a valuation analyst or as a potential financial statement user, somehow have to try and decompose as best you can given the disclosures you've got, and then try and build up your own estimate based on that in terms of doing that. And one of the big things may be, what are your key driving assumptions? The disclosures that are required may or may not capture those, particularly when you start to get into some more esoteric assets. Those tend to have a significantly, there is disclosure there, but it may not necessarily capture the thing that's really driving value in terms of doing that. So you have to really sort of look at that and say, wow, okay, what else is going on in terms of this, in terms of that. And then, just to make it really interesting, auditors interpret the standards differently. And that's where I go back to what I said, very close to the beginning of the presentation. is to really consider and make sure you ask, okay, who's my auditor? And, you know, for instance, I literally just got a client reach out to me for scoping the valuation of a complex warrant. And after going through the agreement, I said, okay, we need to have a call with the auditors now, because I want to know what their valuation professionals, their complex security guy, see if he agrees with my interpretation of the agreement and how it should be valued, and what are going to be the key assumptions that go into that from a market standpoint, and also from a model structure standpoint. And so you need to, confirm those things with that auditor ahead of time, make sure that everybody's on board so that you don't get any surprises on the back end. And this even goes as far as some of the guides that have been written by the either maybe it's something like the AICPA or the Appraisal Foundation. They write a bunch of these guides that help with best practice in terms of doing that. And there are things in those guides that the industry rejected. And so now you're like, well, wait a minute, this is the guide. This is supposed to be, well, it's not definitive by any means. And you have to look at it and say, okay, you got to talk to your auditor. So, all right, what are, from your perspective for fair value, what do I need to do with this? Is this going to work? Can I assume this away? Because we don't think it's going to have a material impact on value. Is this model construct going to be acceptable, for coming up with an estimate on that? All of those things go in, because they're ultimately going to have to be reviewing and approving your work effectively for what's going on there. So understanding how your auditor interprets these things is equally important in terms of doing that. Let's see if I missed anything. Okay, so one other thing I did want to talk about was the audit review process, because I think that's an important one. If you're going to do fair value work, there is an issue with the audit review process that you do need to be aware of. And that is that the auditors will effectively redo your work. And so what you think, well, wait a minute, I thought their job was just to test. Well, the way they test it is they will redo the work. So they will have their own models that they will develop, and then you will end up on a call with the auditors, valuation professional, basically talking about, okay, we're getting this answer, you're getting this answer. Let's figure out why they're different. If they are different, if they're not, great, then you go right through. If they're different, though, you will get that call and you will have those conversations. And sometimes it's as simple as, the auditor has made an assumption that's inconsistent with yours, and you guys talk about it and you go, okay, yeah, either one is reasonable, and you measure it out. But you can have situations where the auditor has structured their model differently if you don't have those upfront conversations, and now you've got an issue. And that's an issue not just for you, not just for the auditor, but for the client, because now from the client's perspective, you don't know what you're doing. The auditor is just being difficult, and you guys need to figure this out. So it's one of those things that you really want to make sure get upfront agreement on, because nobody wins on the back end if there's a disagreement. Okay, we've got a question that says, apologies for straying a little outside of fair. Oh, okay, let's do our polling question first, and then we'll go back to that. Okay, so I'm gonna answer live on this. So apologies if this is straying a little outside of the fair value arena, but in a purchase price allocation, for example, how do you deal with situations where the IRR differs from the WACC? Do you attempt to fix the forecast if management won't, or are you happy to leave the difference as long as there's a good reason for it? Okay, let me take the last piece of that question first, and that about leaving a difference there. If the difference is not large, you're probably okay. I mean, the WACC is and the IRR comparison is a sanity check in terms of what's going on there. If there's a material difference there, the auditor on review is going to see that, and they're probably going to push back and say, okay, you've got an issue. You've got to fix something in here. There is some kind of internal inconsistency in your model such that you're getting those differences. Because in theory, you're not supposed to have taken into account any buyer specific synergies, right? Which would be the primary driver that would force up your IRR. You are taking into account market participant synergies that can justify some delta. But you would think that because it's a market participant, your WACC ought to be pretty close to that. Typically what I see people doing when they get that sort of delta is they'll back up and they'll look at one of two things. They'll look at one, okay, when they develop their WACC, are they really comfortable with all of those assumptions? So invariably there's some type of company specific risk premium embedded in there. Now that they've worked through the whole process, they might have developed that WACC right up front in the analysis. Now they've gone through all this and they've got better information. They've got better knowledge of what's going on in the transaction, what was the thinking behind, the buyer and the seller and why they did what they did. Maybe they need to revisit that WACC, say, gee, okay, I was wrong here. I got that. I need to adjust it. Or sometimes you get a situation where the IRR can be driven up by, as you alluded to, a set of forecasts that just don't make sense, and where this can get really tense is when you end up in a situation where you can actually have negative goodwill. Accountants hate negative goodwill, and the guidance basically around that is if you come up with a situation of negative goodwill, try again. Go back and look at your model, because that's not, fair value does allow for a situation where you can have day one gains, in that type of context. It does contemplate that could occur, but often it's a more matter, particularly in a purchase price allocation, of somewhere along the line, some of your assumptions have gotten, out of whack a little bit. Either on the WACC side or on the forecast side. In terms of, if you really think that there's a good reason for that kind of delta, you need to be able to articulate and point to exactly why. And if you're going to do that, then what I would say is you probably want to do a calibration calculation and say, okay, I've got this big delta. If I make these normalizing assumptions, do the numbers line up? If they do, great. Okay, now I understand why I've got this delta, and maybe I want to argue it, and maybe I don't. But if you can't get that calibration even to line up, then you've got an issue with your model. All right. What's my wife? Oh, this. Okay, that's not. We should have done that. Okay, so let me get back to here and. All right, so conclusion. Let's just summarize what we've talked about. So ASC 820 lays out the framework for fair value measurements. And remember, these are measurements that are for financial reporting purposes only. Now, where most of us will see a potential linkage is when we're doing what we lovingly refer to as 409A analysis, which obviously 409A is tax, but it also trips, it's 718 for financial accounting purposes on compensation. So those two typically are done together. We treat the definitions as sufficiently similar that we end up with one valuation. If you really want to get down into the weeds of that, there's some argument about, okay, you could have different numbers. Fair value doesn't allow things, or at least the auditors don't accept things like a discount for lack of control at the share level. They will accept it at an entity level, where you're, if you're looking at transactions per se, but often in fact, there's been some guidance written about it that they now term it the market participant acquisition premium, MPAP. So you just need to make sure that you're using the right jargon for that. terms of doing that. So we've got that. It is an exit price concept. It's not an entry price. So you're thinking, okay, what is it? What's the value of this asset if I'm going to get rid of it, or this liability if I'm going to transfer it to someone else? It's not, my buy-in price. It is in fact an exit price. It has to be done from a market participant standpoint. You have to identify what the principal or most advantageous market is, and that's where you have to understand, okay, what are the parameters of this asset? Once you've identified that market, that's going to tell you who the market participants are, and that that can obviously vary based on those individual pieces. You've got the 3 levels of the hierarchy that you have to deal with. That's going to drive your documentation and ultimately the company's disclosure. And it really comes down to liquidity and the observability of inputs in terms of doing that. There are things that you can and cannot consider, or I should say must and cannot consider. So you need to make sure you capture those. And like any framework or system, it's got weaknesses and drawbacks, and you just need to make sure that you understand what those are and cover those and make sure that you've got an appropriate level of comfort and documentation, with what those are. And again, if you take nothing else away from this presentation, it's when you are scoping, get on the phone with the auditors. Make sure you guys are on the same page for a model construct and what the inputs are going to look like. Because if you don't do that up front, you get the wrong kind of surprises on the back end. There are some places you can go, okay, for whatever reason, to look for a little additional info. Obviously, the ASC itself, the AICPA and Appraisal Foundation practice aids are out there, practice guides. There are a number of them. They cover different elements of not just fair value, but also specific things like purchase price allocations, like valuations of early stage companies, things like that. There's some good documents out there, but again, read them, understanding they are not definitive. They are guidance, and you need to make sure that your facts and circumstances fit and understand how your auditor is going to interpret them. All the major accounting firms also put out things like handbooks and publications. So you can look to those to try and get more information on the fair value framework and all those pieces. And then the Appraisal Foundation also puts out a bunch of monographs that deal with specific elements. So if you're looking for guidance on one particular technical element, that's a good place to go is in for those. Other than that, I wish you all the best luck. Most of my practice is fair value as opposed to fair market value. There's a big market out there for folks who, if you're not doing it right now, I'd encourage you to take a look at it and get the training that you need. And like I said, there's a lot of opportunity out there, and the fair value engagements. One of the nice things about them is that a lot of times they will end up being annuity work. In other words, you're redoing it either annually or sometimes even quarterly. And so that's a nice thing to have to your business, to have that kind of annuity baseline. So you don't have to start January 1st with a blank slate and having to go hunt your year's worth of revenues. Thank you very much.
Thank you, Jim. Jim, can you advance to the next slide real quick?
Sure.
And yeah, I want to thank you for joining us, Jim, and also for the attendees. It was a great presentation. Just so you guys know, the next AVW International Webcast will be scheduled on May 13th next month, and we look forward to seeing everybody. Thanks for joining us. Thanks again, Jim.